Okay, so as I just mentioned, our next session is on the rise of ESG, and I think I said earlier in the day it's something that we keep getting feedback from, that there's more interest, certainly from clients, and that advisors want to hear more about this. Now, I won't take all of Leah's presentation away from her, but I just thought a couple of interesting things I saw recently. One was I read about a survey that was done by Natixis. They surveyed 2,700 financial professionals all around the world. 61% of those advisors said that ESG was something that was being driven by client demand, 61% of them. However, only 32% of them said that they were actually doing something about it. So there's certainly a client demand there, and perhaps something that needs to be caught up on the advisor side. The other thing I'll do before I hand over to Leah is, the title here is The Rise of ESG. And of course, always being different, our friends in the US, some of them are certainly taking a different approach. And I saw something in the FT lately that US Republicans are pulling up to $1.6 billion from BlackRock over ESG concerns. Not that BlackRock's not doing enough on ESG, but the Republicans think they're doing too much. And they're actually, the governor of Florida, amongst others, is telling their pension funds that they're not allowed to screen for ESG. That's the sort of other extreme view, if you like. So to discuss this and many other things on this topic, we have a presentation shortly by Leah Willis from Australian Ethical, and then Leah will be joined on a panel moderated by Rogan from Russell, and joining the panel, James Harwood from Russell, Michael Salvatico from S&P Global, and Deanne Baker from Lonsec. So please welcome Leah Willis.
Hi, thank you, and welcome, and it's nice to be back in Melbourne again and seeing familiar faces. I'm really not the expert on the panel today, although we have been doing this for over 35 years and it's something we're extremely passionate about, as I've probably said in this forum a few times before, but obviously a really esteemed panel that joins us on the whole topic of ESG, with probably some differing views today as well. So I guess my intro is really just to frame it up, to give you what is the RI or responsible investing landscape. Why are we considering it? Why are we up here talking about it? And I kind of always reflect when I come up here after all the other sessions that have come before us, ESG invariably comes up, and I heard it in the last session as well. But why is it such a big topic and such a burgeoning topic, I guess, particularly for advisors? There's no doubt there's a shift in society, and that is tipping over into investments. And so I thought a really good backdrop would be to quote the latest Responsible Investment Association of Australia's benchmark report. They are the leading organisation that has been benchmarking responsible investing in Australia for well over a decade. And they come out with a report every year that measures responsible investing and the assets under management and the managers that are actually doing responsible investing. Interestingly, they have been tightening up their criteria, and they now have, I guess, what is self-assessed ESG or responsible investing, and then also leading responsible investing. But as you can see, that green part is 74. They're the leaders in responsible investing in the Australian marketplace. $1.5 billion now under management. It's about 43% of the current investable assets in the Australian marketplace. So a couple of interesting things there. So there's obviously a lot of managers that are self-assessing. They may have particular sustainable options, or they may have a particular approach around ESG in maybe some of their assets, but the Responsible Investment Association has been tightening and saying, well, you need to have it across most of your assets, and you need to be sort of committed at a much deeper and broader level. So you can see that, if you had that sort of broader approach, it would be over $2 billion that's self-assessed in the Australian marketplace today. There was 140 managers that actually self-assessed, and there was 74 managers, as I said, that got that leading score, which is a 15 out of 20 from RIA. But what are some of the takeouts for you? And so I should probably preface saying, it's almost $1 in $2 here in the Australian marketplace now of professionally managed assets. So it is fast becoming the mainstream here in the Australian marketplace. So probably something that advisors obviously need to stand up and take notice of if you haven't already. But what are some of the, I guess, key takeouts from that latest RIA report that only came out in the last month or so. ESG integration, no surprise, makes up half of the market in terms of the RI assets. It is the most popular approach in terms of responsible investing here in the Australian marketplace, but probably globally as well. It's probably what we would regard as the lightest touch in terms of responsible investing, but it is fast becoming mainstream. And we would hasten to say that this is where all investment management is going. If you think about the signatories to UNPRI and their latest strategic intent over the next decade to make sure that investment managers are actually having real-world outcomes in terms of their portfolios and the way they invest, there is no doubt that every investment manager is going to have to consider ESG to some extent in terms of their portfolios and investments. But you can also see negative exclusions is actually increasing, no doubt things like tobacco, but increasingly things around fossil fuels. With the explosion that we've seen in ETFs, but also sustainable and I guess thematic ETFs, you've seen many more exclusions taking place as an approach to responsible investing. Corporate engagement comes up, particularly when you look at the super fund marketplace here in the Australian marketplace. Engagement, advocacy and shareholder activism are quite critical approaches that many of the managers are now taking. And then you'll see the other approaches in terms of sustainability and impact investing. One of the important takeouts of that is while ESG is dominating, I guess, in terms of, about half of that responsible investing marketplace, you'll see here that allocating capital right down the bottom, if you have a look at the report, this is really a measure of what are the outcomes or the impact of the particular approach that these responsible investing managers are taking. So it's their commitment to responsible investing and benchmarking that out of 5, their systematic approach to actually managing ESG risk. Are they being strong stewards? Do they actually have active shareholder approaches? And then also the allocation of capital. And you'll see the allocation of capital, which in the eyes of the UNPRI is probably one of the most critical things. And if you think about the SDGs and just the critical state of some of the social issues on top of environmental and climate issues that we face around the world today, this is a really critical part of responsible investing and one of the outcomes that we would like to see more proactively considered by any responsible investor. But as you can see, it's probably one of the lowest scores there. So while we have this massive sort of marketplace of ESG investing, we actually know that what they're still investing in is not necessarily driving the capital to maybe the right outcomes that someone like Leah or potentially end investors and clients may actually think is sort of, I guess, delivering the outcomes that a responsible investing approach should actually deliver. So obviously that creates, I guess, an opportunity for many managers to think about what is the impact, what are the outcomes, how do they measure that, particularly when they report back to investors in terms of the decision making that they're making through their RI approach. And then I thought another key takeout was the consumer searches. So you'll see here that RIA benchmarks in their report each year what have been the searches on their website by consumers in terms of what are they typing in when they're looking for their responsible investing options? What are they looking to invest in? What are they looking to potentially exclude? So how are they sort of searching the RIA website for that information and guidance around responsible investing? And you'll see there's a really overwhelming, I guess, theme here around environment and around climate. Things like sustainable land and agriculture, renewable energy, sustainable water, social infrastructure, etc. So I think that gives us a really good feel for the demand, I guess, that's out there in the marketplace around consumers and what they might be expecting from managers, but also what they might be expecting from your advice recommendations as well. And if you're not asking the question, what are some of the positives, but also what are some of the exclusions that they may actually want to take in their portfolios? To round that out, I thought it would be interesting ahead of the discussion today to give you a feel for what we think is on the landscape, not just from a responsible investing perspective, but I guess more aptly from an advice perspective. We think that climate and the transition that the Australian economy has to undergo, obviously we now have a federal government that is in the most part committed now to climate transition. So that is going to be an enormous change for whole industries, for whole sectors, for whole communities. And no doubt that will flow through to the share market and the sorts of investments that you can or will be able to make today and in the future. Not everyone will make the climate transition, and there will be winners and losers. And that has portfolio implications for you. Increasing regulation. So we saw overseas that the EU taxonomy has led in this space for a very long time, but you've also now seen the SEC in the US, you've seen the ASX, ASIC and APRA all come out with guidance around labelling and greenwashing and wanting to see much greater alignment, and they will regulate more and more around this alignment between the label that you put on a product and the outcome that you deliver, particularly when it comes to ethical or ESG or green labels. And then the final thing will be that measurable impact. How do you take what you invest? How do you measure the portfolio outcomes against things like carbon footprints, net zero commitments, and also SDGs? And we know that the regulation will push more and more of that, but also the investor demand is actually there for more transparency as well. And then really finally, we released an ESG survey with investment trends earlier in the year, and this really sums up a lot of what you saw out of the RIA report, and probably is just a really nice reinforcement of some of the messages. We have this on our website. We'll circulate it post today so that you can actually have a look through it. We have an investor perspective and we also have an advisor perspective. I guess a couple of the key takeouts I wanted to touch on today was there's about 75% of investors are either now investing in ESG or responsible investing, or in fact are looking at it and want to learn more. And that next wave of ESG investors, that 33%, is actually looking for more advice and guidance as well. So they will be coming to you. It's the next wave of ESG that we think actually provides you as advisors with a new frontier or a new opportunity in terms of your advice. The sorts of things that they will be looking at really aligns to what you saw from the RIA report, very, very similar, with a really strong, environmental bent. And then those current ESG advisors see a real business benefit from engaging in this. So you'll see down below enhancing value proposition, building better rapport with existing clients, but also attracting more clients with some of the benefits that those advisors that are providing ESG or responsible investing advice actually see in terms of their own businesses. So I just thought that was a really interesting backdrop to show you the demand, the rise of ethical and ESG and responsible investing, and then some of the business outcomes. And with that, I'll hand over to Neil.
Thank you, Leah, and good afternoon, everyone, and thanks for joining this session this afternoon. I mean, there were some really interesting points you've highlighted there. Leah, come and take a seat next to me, that you've highlighted there, and I think, you know, this goes to the first question I'm going to ask Michael, which is really around if we've got $1 in $2 going into an ESG type fund, we've got 75% of consumers interested in investing in ESG. If I'm an advisor or I'm a consultant, where am I going to get information about these ESG funds?
As an introduction, I think it's also important to think about why that's the case and reflect on why we're seeing such growth in ESG or sustainability. I think is probably a broader banner and just what that means. I think we're at a zeitgeist or we're at a changing time. The zeitgeist at this moment is to focus on not just profit and improving the profitability of companies, but also growth of companies in a sustainable way. And the ability to identify good companies, what a good company means, and companies that sell good products is a conversation that everyone wants to have, right? All advisors want to be pointing their clients to good companies. And this is what sustainability can offer in terms of providing more information about what that company does. And so to come back to your question, Neil, around, you know, where do you find information? Well, there's plenty of sources, including the companies themselves, that are providing analysis on their own sustainability reporting, climate change reporting. So there's definitely availability of that data. I myself work for S&P Global, and we spend a lot of time analysing companies. We spend a lot of time analysing companies across all the perspectives of companies, financials, asset level data, the fundamentals, but also their sustainability profile. Even within the sustainability profile, there's a lot of different layers of analysis. We saw from the approaches that Leah put up, there's ESG integration, there's impact, there's screening. All of those different approaches to sustainability require different analysis. So we have teams and teams of people who are looking at this. There's over 800 people at S&P Global who do focus on ESG and sustainability analysis only, out of the 33,000 people who are looking to provide solutions around indices, credit ratings, energy transition analysis, commodity pricing research. And the reason I mention each of those is because that's the area that sustainability touches. Sustainability touches every part of the economy. It's a transition from a climate change perspective that we need across every part of the economy. So it's important to be looking at how companies behave from an ESG integration perspective, to analyse them from the perspective of not just their financial capital or their intellectual capital, but also their human capital, the social capital, the environmental capital, the customer capital. All of these things make up the value of a company nowadays and form part of that ESG integration. It's important to analyse a company from an ethical perspective, and this is an area I'm looking at Leah because I know that Australian Ethical focus a lot on these issues around animal rights in particular, so that a deep dive analysis on a company's impact on and use of animals in their assessment of products and services. But also gaming, tobacco, alcohol. These are an analysis of a company that indicates a different aspect of a company from the ESG integration that I mentioned earlier. Leah also mentioned SDGs. This is something that's on the horizon. We're halfway through a period of time where SDGs were developed in 2015. They also have a deadline of 2030 to achieve their targets. It's a different aspect of analysing a company. It's positive impact. We're going to see more focus on that. And then, of course, the bit that also is on people's minds, as we saw, is the climate change analysis. We spend a lot of time analysing companies from a transition risk perspective and a physical risk perspective, because these are the areas that are affecting us or people that we know, the companies that we invest in, the value of those companies. And so that climate change analysis has become such a big part of the conversation that I'm having with investors, with advisors, with banks, with corporates, who are looking to ensure that they manage a risk and take advantage of the opportunities that we see.
Thanks, Michael. And I mean, at the end of this, we might come back. I'll put you on notice to say, where's one spot the people in this room can go to find, consolidated view, or is there something on your website that we can direct the people here today to go and have a look at for some more information? So we'll come back to that at the end, but just putting you on notice, ready for the wrap up. But just a question now for the various portfolio managers that are sitting here with me this afternoon. If we've got a client-led demand for these types of products, and then on top of that, there's probably a licensee demand for these things, or a dealer group demand. We'll start with you, Deanne. How can these needs be incorporated into portfolio design, and what are you seeing and how are you responding to it?
Thank you. Look, I think historically, if we think back to how, I guess, ESG or responsible investments were incorporated into portfolios, typically what we saw was, from an Australian perspective, was an Australian equity portfolio substituted in amongst a range of other managers, and that kind of suited most clients quite well. I'm doing good in this part of my portfolio, that's what I'm trying to do, with paying little regard to, I guess, what else was in your portfolio, whether it be your other equity managers, what they were doing, what they were purchasing, or whether it be on the fixed income side, who are you lending money to. I think, the market has evolved quite a lot, particularly in the last 2 years, and now we're really seeing clients demand, a whole of portfolio solution. So they're wanting to know that, the impact they're having is being had across the entire portfolio. So what we are seeing is a move towards more holistic portfolio construction, where we're seeing ESG and sustainability incorporated across each of the major asset classes. There's still some gaps, and we can touch on that later. But for the most part now, there's enough product availability and enough quality of products, particularly in Australia now, that you can build a fully diversified portfolio while still getting either impact or exposure to more environmentally, socially and governance-aware kind of strategies.
Thank you. And James, from your perspective?
So just for the audience, my background is equity, ESG investing. So I run some Australian shares and global shares equity portfolios. I think it's worth highlighting that measuring equity for ESG it's been relatively straightforward and quite standardised now for a few years. So you can quite easily look at a portfolio's carbon footprint relative to its benchmark, for example. We've started to see a move more into the managed account space. So I think once you move away from equities, it does get harder to kind of report from a total portfolio perspective. It's definitely gotten better in terms of ESG data for say fixed income, but trying to say that a multi-asset portfolio has got a 50% lower carbon reduction, let's say, is harder than doing so for a simple equity portfolio. That's evolving, but I think that's increasingly what advisors are. They're looking for that kind of information. I thought Leah made a good point. Looking at the RIA survey, you asked about where can advisors go for information. I think the RIA website offers a lot of good information on individual products in terms of what are they doing. I'd also highlight that what I expect we'll see over this decade is almost a merger of some different portfolio approaches. So I think what you're starting to see now is a lot of the core portfolios increasingly having some kind of ESG integration. That's definitely what we've used for some of our asset classes in the ESG managed accounts that aren't in the equity space. So I think you'll see a lot of core funds kind of move in that direction as well. As you know, we've committed to be net zero, and we've started to make interim commitments for 2030. So I think over the course of this decade, you will see more and more integration, even for core funds. But yeah, and maybe the last point I'd make is the greenwashing comment from Leah as well. Being very clear about the product labelling. That's something we spend a lot of time with RIA when we're getting our ESG products certified, and making sure that we're being very clear on what a particular product brings from an ESG perspective.
Yep. Thank you, James. And Leah, from your perspective, I mean, you've got a whole business based on this. So.
I'm still, yeah. So what was the question again?
How are you designing products and solutions for both a client and also for, say, a licensee or an advisor based on?
So I think in the ESG survey that we did as well, we did actually survey both investor and advisors around their perceptions and appetite and demand and all of those sorts of things. And so advisors had 3 clear ways that they're incorporating ESG or responsible investing into their businesses, and it's probably no surprise. It's either the bolt-on, almost a sustainable thematic. So I'll put a couple of products in there that are going to access this thematic. Because I'm going to keep my models as they are, I've kind of maybe done a broad ESG overlay. I'm fairly comfortable with what I'm doing, but I'm actually wanting to access that and probably wanting to talk about it and wanting to have some kind of positive thematic within the portfolio. Then there is the off-the-shelf solutions, which we have a range of multi-asset products, as do probably all the managers, but also particularly, as a couple of people have already mentioned, the managed account space is massive. So the likes of Lonsec, developing managed accounts that dealers and licensees and advisors can just take off the shelf. They don't have to reinvent their business. They can incorporate it into their advice recommendations pretty seamlessly. And then what we're seeing is we don't sort of do investment advisory at all. That's not our role, but we work with investment advisors and consultants and a lot of high net worth practices that are looking to put their own managed accounts or own model solutions together. It's a reasonably long process. It can take anywhere from 6 to 12 up to 18 months. But having said that, when I started 6 years ago, we were, at Australian Ethical, we were instigating the conversation, whereas now we have a fairly steady flow of inquiries coming through saying, I really want to do this, I want to embrace it, can you help me? Who's done it before? How have you helped others navigate it? And as Deanne mentioned, there's plenty of product and there's enough to put a fully diversified portfolio together. And I think that the piece that you are starting to see, which is super interesting, is private assets and unlisted and impact investing. It used to be that someone would tack impact investing onto the side of their portfolio, maybe do some social disability housing or something like that. It was the feel-good factor, and that's not taking away from the fact that they're brilliant investments and they have a real purpose, but I think you'll see more product coming to market that will allow even further diversification and further impact outcomes out of portfolios.
I mean, one of the things I hear all the time when we're out on the road or talking to groups like this is when you talk about ESG, straight away people go to think about the environment. So I'm interested, where the S and the G fits in terms of portfolio design, but also maybe Michael, firstly from your point of view, in terms of the kind of information you look at and the kind of things you look at. You touched on that earlier, but where does the S and the G fit in terms of, from your perspective?
Let's see if this is the right one. Yes, it is. Great. Thanks, Neil. So the two aspects that I mentioned earlier were from an ESG integration or analysing a company, the human capital and the social capital. They sort of align under our S dimension when we're looking at companies. And the emphasis there is on, many companies, the value of the company is the people in the organisation, especially in this room, right? We're in services industries. It's you. You are the value to your organisation. And so it's recognising that value through how to attract talent, how to retain talent. It's about the health and safety of the employees. It's measuring these metrics at a detailed level. And best yet, if the company is telling you this information in a way that's standardised. So a lot of companies are willing to share the information that they have. Like I said, they're reporting details in their reports, but ensuring that the scope of what they're measuring is consistent across different countries, where there's different laws, where there's different needs for them to report across their organisation. That's the real challenge. And so that's where we spend our time, collect information from these companies and make sure that it can be compared, that there is some standardisation, so that when you look at it, you can very quickly screen for companies based on a particular aspect. And that might be lost time injury rates, for instance. It might be a diversity metric, proportion of females, or we go even further than looking at gender now when we look at diversity within organisations. So these are databases that you can then access to better understand the individual companies that you're looking at. And the analysis now is covering thousands of companies. For a lot of the research we look at, it goes deeper than 450 companies within Australia, 15,000 companies globally. Now we take this analysis, and I've had a lot of portfolio reporting talk here, which is fantastic because that's how you're going to be able to analyse the investments that you're making. It's at that level, that portfolio level, that's going to be easiest to access if you're looking at ETFs or at managed funds. So having that consistency of analysis at the company level is really important to bring that up to a portfolio. And again, coming back to the question focused on social issues, looking the examples I gave were very focused internally on the operations of the company, but nowadays that goes further into human rights of an impact on local communities. We're measuring these details and bringing those into how a company is assessed. And using those in benchmarks that are created by S&P Global, whether it's a carbon efficient index, or whether it's an ESG scores index, which then allows for the portfolios that we're talking about here to measure against a benchmark, the same way you would measure the performance against a benchmark. And one more point there, I know, Neil, this is an area of social issues which maybe isn't as well talked about, but some of the things that we touched on, the SDGs, for instance, are very focused on social issues. You know, those look at equality. They look at how to take people out of poverty. They look at how to ensure people have a roof over their heads. These are all measures that companies are looking at, or increasingly looking at, as I say, as we get closer to the target dates of 2030.
Thanks, Michael. And I think, yeah, you raised some really, really good points there. And I just want to kind of pivot them slightly when we talk to the portfolio managers here to say, well, yeah, how are the S and the G considered? And then what shouldn't be in an ESG portfolio and what should be? So something like maybe nuclear power, should that be in an ESG portfolio or shouldn't it be? So I just thought I'd dial it up a notch for our portfolio managers here, just to cover the whole gambit. So it's more than just, you know, the environment, but then if it's more than the environment, where do you draw the line?
I might kick that off. This microphone works as well, so thank you. And I'll start with the second part of the question first, and you know what should be in an ESG portfolio and what shouldn't. And you know it really does come down to individual client preferences. It's really hard to design a portfolio when you're talking about individuals' values and ethics. You know what's important to me may not be important to somebody else. So it is important to have a conversation with your clients and figure out, you know, do they want to be invested in tobacco? Do they want to be invested in gambling and those kind of issues, and really understand where they're coming from. But having said that, as portfolio managers, we are designing managed accounts for a broad range of clients. So we do have, I guess a range of exclusions or limitations in terms of activities that we think are fundamentally misaligned to our objectives, which are the United Nations Sustainable Development Goals. So there's a range of activities that we think, you know, certainly don't contribute to making the world a more positive and a more environmentally safe place for people to live and work. So we do have limitations on things like coal mining, fossil fuels, gambling, controversial weapons, nuclear, etc. And nuclear is an interesting one because, you know, certainly from an Australian point of view, most of the clients we speak to, it's quite unpalatable. So we do kind of have some limitations around how much nuclear we will be exposed to. And that really comes down to the fact that, you know, Australia can be a renewable superpower. You know, we have lots of wind, we have lots of solar. You know, we have other sources of energy that we can use. And when it comes down to it, nuclear is not zero carbon throughout the life of the investment, once you take into account the amount of concrete that needs to go into the reactors and those kind of things, and it's expensive. So it gets a few crosses from an Australian point of view, but if you're sitting in Northern Europe and you don't have those wind resources and you don't have those solar resources, then nuclear becomes a much more viable source of energy. So, you know, you find in a lot of European portfolios, even if they are kind of ESG related, that they do have some exposure to nuclear.
Thank you, Deanne.
Yeah, look, I'll maybe start with the G, the governance side of things, and I think if you're in an active product, most fundamental equity managers are quite big on governance. You know, they're obviously meeting company management. You generally have quite high governance scores, if you like. So I think on the whole, active management, you get the governance side on the whole, particularly if you're investing in ESG-based fundamental strategies. The social side is definitely more challenging, particularly from, say, a listed equity space. Leah mentioned, things like social housing. There aren't many kind of social housing stocks that are listed on the ASX. That there are things like healthcare. I think ESG-minded investors will often be overweight sectors like healthcare because that's a social solution and doing good for the community. Maybe the last one I'd just touch on is around the exclusions side of things, and I think this is where it gets a little more challenging. I'll touch on nuclear as well. Clearly in Australia we've got a big mining sector. We've got the so-called just transition of when we're transitioning out of fossil fuels for, say, our power. What does that mean for communities? So I think there's an aspect there to think about. But I think it's fair to say that most ESG-minded funds and investors would look to not have coal exposure or more than, say, 10% of revenue from a company coming from coal. So that's been a fairly standardised exclusion. But it's something to really think about. And as you know, when we're building products, we try and marry up, the risk and return side of things, and looking to produce products that kind of try and get that balance between ESG and risk, getting that right. So, I don't think just excluding all mining is the way to go. We know that there's critical metals are going to be a big part of the solution as we decarbonise. And then maybe lastly, nuclear. It is quite a polarising subject. I don't expect we're going to have nuclear power stations in Australia, but I'm sure Germany would like to have their nuclear power stations back up and running again. So, the way we look at that from a Russell perspective, in some of the low carbon strategies that I run, we regard nuclear as kind of as a grey source of power. It's neither renewable or fossil fuels, so we don't look to kind of tilt towards it, but we wouldn't necessarily exclude it from all of our strategies. So we would exclude nuclear mining, so uranium miners, that's something we don't have exposure to, but nuclear power is, I think, still part of the transition, the solution that a lot of countries need for their energy.
And Leah?
I might just pick up on a couple of things there. I think Deanne made a really good point when she stated their objectives and what they align to, and I think that's really critical for this audience. Is there's lots of different approaches to responsible investing, and I think I've said in these forums before, you wouldn't expect every active manager to do everything exactly the same, because that would be really boring, wouldn't it? You wouldn't have many managers that you could would complement each other, and so responsible investing is no different, but it is probably, there's a complexity to it in terms of understanding what's the label, what's the approach, what's the outcome that I expect, and do they all align? And I think regulation will take us closer to that and help in that process. But I do think, understanding if you're aligning to UN SDGs or if you're aligning to carbon emissions or various other outcomes, just being clear on what the manager is sort of promising, I guess. We also, as a sales team, use the Ethos platform to help advisors to align clients' values with the portfolio outcomes. That does take in not just environmental, but also social and other issues that are personal to the investors, and can help sort of align the right products. And so we've been using that just as a support tool with advisors to help them navigate some of those sort of more critical values issues. And then the third thing I just wanted to say was in terms of our approach, I guess, which I guess goes deeper and probably than ESG. So we definitely use ESG indices as inputs, and they're really critical. That's where you do get a lot of your baseline E, S and G kind of indicators from. But then we have our ethical charter we apply. But the call-outs I wanted to make there was things like human rights. We use actually a lot of international NGO research and papers, because they are really at the grassroots levels of fast fashion, fast tech, particularly in developing nations, but also just across sort of across Europe, etc. So we use a lot of that to help support around human rights issues and some of the considerations. And I would also say we use a lot of academic research and particularly university research, particularly things around animal testing and animal cruelty, and reducing overall use of animals in things like biotech and healthcare. So that's some of the supplementary stuff. And then I would even say active engagement is super important as well, and not behind closed doors, but having open conversations around impacts, particularly on First Nations communities and things like that, where we understand the full impact of a company's products, services, and then how they also operate their business is sort of how we think about some of those issues.
Great. So 2 last questions before we might have time for questions. I'll just check with our timekeepers. So we'll go back this way this time. So firstly with you, Leah, what's on the horizon? So you look 2 years ahead, where are we at with ESG? And what would be your one piece of advice to an advisor in the room who has a client come in tomorrow and say, I want to invest in an ESG fund?
Wow. I think you will see more advancement on social and animal issues, in particular. Social equity and animal rights and cruelty come up time and time again from investors and from communities that we talk to. So I definitely think environment, climate, once we have more leadership from the federal government, once we start to see the transition here in Australia and it actually starts to get costed in, I guess, to the economy, that will throw open so many opportunities. I think that our portfolios will have to fundamentally keep up with the transition that the Australian economy will undergo, and every manager will. And we will have to keep a really close eye, and we already are starting to think about it really critically in terms of how we as a manager, and on behalf of our investors, I guess, that we're stewards for their money, how do we actually really navigate the pros and cons of the transition, and also try and, produce financial security out of it. So I think climate and environment will continue to be a really big issue, but I think with more leadership, it will kind of start to take care of itself. I think social inequity, human rights, animal welfare are going to be some areas where I think more managers will start to stand up and start to take a deeper and broader stance on.
I think ESG integration, I mentioned it earlier, but I think that's going to be a continued big growth area for core strategies. I'd also expect better reporting over the next couple of years. I think improved reporting across asset classes will see that. Have I just taken your answer there?
S&P will fix that for you.
And then just in terms of, what would you say to advisors? I think, it's a tough space, but just trying to get to understand, what's important to individual clients. We all know that, individual client ESG beliefs are quite personal. So, I don't think necessarily just blanket exclusions are the way to go. I've definitely become a firm believer in the increased use of engagement as well as a way to affect change. So I think that exclusions over engagement is a good kind of topic to have with your clients.
I'd certainly agree with Leah that climate change is here. It's not going away. It's something advisors need to be across and need to have, I guess, solutions ready to go for their clients. I think probably what's coming next on the social side, certainly issues around diversity, particularly gender diversity, we're hearing a lot about. Also hearing a lot about modern slavery, obviously, given the regulations. So that's another area. And I think the next one will also be nature-related disclosures and biodiversity. We've got the Task Force of Climate-related disclosures already, and there's nature-related disclosures coming. So they're more areas about on the ESG type front that we expect to see going forward. Other things to keep in mind, regulation that are becoming thick and fast as well. Obviously Europe and the US, or particularly Europe, are well ahead of us in that area. Voluntary disclosures here now, soon they'll be, I would expect them to be mandatory. So lots of moving parts. What was the other question? Sorry, Neil.
Advice. What piece of advice? I've got a client coming in tomorrow, Deanne, what do I do?
Yeah, okay. So again, there's plenty of resources out there, and of course I'm going to say this, but use your research houses. There's plenty of support on Lonsec iRate. We do a lot of work in determining fund managers' ESG credentials. A lot of it's forward-looking. We look at how they do their engagement, how they vote on their proxy shareholding, these kind of issues in addition to kind of backward-looking data. And then also sustainability as well. And we look at how sustainable a portfolio is from the bottom up. What are the products and services these companies are producing, and what impact is that having on the planet and society? I'll stop.
Great. Thanks, Deanne.
Thanks, Deanne. You took my biodiversity. that was my big one that I was going to add. I almost got there. It's huge. So biodiversity, the expectation around it is it will be bigger focused than climate change, and it's using the same framework that climate change uses, which is the Task Force on Climate-Related Financial Disclosures, TCFD. TCFD came out in June 2017. Took a couple of years to get the attention of companies and investors, but nowadays the number of supporters across the world, it continues to grow. It's on everyone's minds. It ties in very well with net zero commitments by countries, by companies, by investors, by organisations like S&P Global. Provides a great framework to understand the governance, the strategy, the risk management, and the metrics. The metrics are the part that I'm here to represent, as we've said throughout this. It's what S&P Global does. It quantifies these risks. We talked about how companies report. What you need to do as investors is understand how to quantify these risks in a consistent way, a standardised, transparent focus on reporting for ESG, just like financials. Right? You expect the data coming to you for financials to be correct, to be accurate, to be comparable. Your expectation around ESG data, whether it's ESG integration, whether it's screening, whether it's SDG aligned, EU taxonomy aligned, greenwashing aligned, TCFD, TNFD, SFDR, right? The acronyms go on, but they're all important. These are helping frame the focus. They're all different focus. The importance here is being able to quantify it. You can go to our website and see our ESG scores. Go to our website, type in the ESG score for BHP. Go on, do it. HP, do it. Any company. If it's not there, then you probably need to buy a subscription, and that's where you need to see someone in my team. The emphasis there on engagement, so important. We touched on it right at the end, right? I've said it a couple of times. We need to transition the entire economy, not just the parts that we like. To do that, divestment is a very blunt tool. It's a tool. Engagement is becoming a bigger focus on how to transition the AGLs. How do you turn AGL from being 10% renewable, 90% fossil fuel to being 90% renewable, 10% fossil fuel? I said that 3 years ago, and the audience were like completely, disbelieving. But nowadays we think it might be possible. Transition, again, I emphasise it because it is focused on climate change. Climate change is what you hear a lot about. Environment's what we hear a lot about because it's a number. We're in finance. We like numbers. We know what we need to do. We know how much carbon emissions we've got today. We know what we need to do to reduce it. Well, we know that we need to reduce it. We've got a target, right? 300 gigatons of carbon budget left. Reduce our emissions by 50% by 2030. It's as simple as that. The hard part is analysing where that's going to come from, because it has to come from companies, right? More than 50% of Australia's carbon emissions come from the ASX 200. But we know where that comes from. We can engage them. We know that they need to align to Paris. We know what that means. If they don't achieve that, the likely outcome is a carbon price. So then you need to know what the carbon price risk is in your portfolios. One more comment on nuclear, because energy transition is such an important part of how we deal with climate change. We spend a lot of time looking at energy transition. I got asked a couple of times today about nuclear, about green hydrogen. Yeah, we see that every energy source plays a role in the future decarbonisation. For instance, green hydrogen, our research would indicate that it's going to contribute 7% to global decarbonisation, largely through its role in decarbonising transport. If you want to know more about those kinds of research insights, you can go to our website too, S&P Global Energy Atlas, and look at the different energy, look at the different fuels, at how energy is created across every power generator in the world, and what they're doing to create that power. So there's plenty of information. No lack of data is the other thing. And I don't think I've gone on far too long now, Neil. I'm going to stop.
Thank you, Michael. And I think we might have time for a question, David. Do we have time for Toby questions?
Questions? Yes, one over here.
Look, we've called the session the rise of ESG, and obviously that the statistics we've talked about early on back that up. But I've just wondered, I mean, we've seen coal prices at a record level. Best performing sector on the ASX in 2021 was energy. To what extent does that, and perhaps people seeing their ESG-themed funds underperform benchmarks, take away from that rise? Do you see there's a risk of people sort of easing off on the focus on ESG when they see some of that happening?
Oh, I've mic'd up, I keep forgetting, I'm sorry. Yeah, it's obviously a really common question we get at the moment, and to be really transparent, we've had a pretty tough 6 months. We don't invest in any direct fossil fuel companies. We have some indirect exposure through a number of renewable companies, but we have paid the price for that in our portfolios. It's short term though, and it's interesting actually, having spent a very long time in the industry with active managers and some of the best in the world. I keep reminding my team that 3 months, 6 months, 1 year is still short-term performance. And yes, we've had a beautiful 20 or 30-year track record of outperformance, but there has been glitches in there. It's just that we weren't in front of audiences like this talking about it at the time, but we're like any other active manager. Our portfolio is different for various reasons, and so we will have some short-term underperformance when sectors such as fossil fuels outperforms on the back of a global energy crisis, and on the back of a war that none of us would have ever probably envisaged 12 or 18 months ago, on the back of COVID. So there's a lot of kind of compounding issues there. So we invest in things like IT and healthcare that have also conversely been impacted by valuations in the last little while. We remain completely committed to our stance, and I think it was actually a Lonsec presentation I went to quite a few years ago that showed that what we were used to in the Australian economy, this industrials versus resources, this value versus growth, this 5 or 7 year cycle of outperformance and underperformance, is just not the case. And so I think we have to look forward and say, are we fundamentally going to stop the transition to net zero? Are we fundamentally going to remove those commitments to a renewable energy transition? Highly unlikely. What you will see is a lot of those traditional fossil fuel companies transition and do really interesting things, and it's just a matter of navigating that transition. But I think to have conviction that we don't all of a sudden invest in fossil fuels because it's taken off in the market, and that we have a real commitment to net zero and the potential risks that poses to the Australian economy, but also the global environment.
Deanne and
can I
James,
just add?
You're both running portfolios as well. So.
Yeah, I mean, absolutely. And I'd have serious questions about any managers in our portfolio who would have outperformed over the last 6 months. I mean, we don't want to be invested in those fossil fuel industries, and that's been a very narrow part of the market that's performed well. So I think, when it does come to these periods, it's really about the communication, and we've been, quite upfront with our clients about the impact of not having energy in the portfolio will have on short-term performance. And for the most part, in fact, I can't think of any example of when a client said, well, that's not satisfactory. They're willing to invest over the long term and ride out these minor periods of underperformance.
Yeah, maybe just to close, I think for advisors, the key thing is to think about, shade of green that, is appropriate for a particular client. Aussie Ethical, great stock pickers. Darker shade of green, avoiding, a lot of the industries like fossil fuels. There are other solutions that are, a medium shade of green, and I think, often when we design funds, it's more in that medium shade of green because of some of the, the kind of biases and risks that you get with ESG strategies. So, I think that probably shows the value of an advisor, understanding clients and knowing what their risk tolerance is and how darker green a product that they want. So maybe a good way to close.
Just one thought on that. I totally agree. I think there are two questions. There's ESG as analysis that identifies good companies and good products, and that's an assessment across every company. That includes fossil fuel companies, and then there's analysis of climate risk, which might include screens on fossil fuel companies and divestment from fossil fuel companies. So, I suppose in answering a question that you asked earlier, what do you need to do to find the right ESG fund for your clients? It's understand what that fund does. Because like any other type of fund, it was mentioned before, whether it's value, whether it's growth, whether it's quality, you need to dig in below the label of what the fund is to understand the methodology and the approach, and make sure that's consistent with what your client is looking to achieve.
Any other questions, Toby? All good?
We're getting the wind up.
Great, thank you. Okay, well, please join me in thanking Neil, Leah, James, Deanne and Michael for a great presentation.